Hey everyone, welcome back to the channel. It's Wednesday, April 1st, 2026, and SPY is currently trading around 654. Right now, the market is sitting inside a significant resistance zone after clearing the prior support level. We're in a hold/watch mode. No new long entries are being suggested because price is no longer at support, and we're not initiating shorts yet as we move into the April 22nd to 28th time window. The key levels to watch are resistance between 654 and 671. A clean break and hold above 671 would support continuation higher. However, if price stalls or fails near 654 to 660, it could set up a pullback toward the 630 to 645 zone. The current bias favors patience until we get clearer confirmation at this resistance area. Now, let's connect this to the bigger 2026 picture we've been building in the project, with a fresh update on inflation. Recent forecasts are now showing inflation continuing to ramp higher all the way into Q4. This is a meaningful shift from earlier expectations of cooling prices. If this plays out, it would create sustained pressure on the Federal Reserve and complicate the policy path significantly. This rising inflation outlook ties directly into several of our project systems. In Q2, the combination of potentially slower growth and sticky to rising inflation strengthens the case for a regime shift. The new Fed chair transition, Kevin Warsh nomination still pending, with confirmation possibly slipping into May or later, adds another layer of complexity. The core dilemma becomes even sharper. How aggressive can rate cuts be when inflation is not only sticky, but potentially moving higher? A more hawkish or delayed easing cycle could amplify downside pressure. Our time and timing system continues to highlight June through August as the highest probability window for the sharpest decline. If inflation keeps ramping into Q4, this window becomes even more significant as it overlaps with peak policy uncertainty and potential stagflation-like conditions. Q3 could see these pressures peak, with stagflation risks rising and multiple compression becoming more pronounced on equities. Gold and defensive sectors may continue to attract interest as hedges during this period. Q4 still offers recovery potential, but the path there may be more challenging if inflation remains elevated longer than previously expected. A 20% correction sometime after the new Fed chair arrives, but before Q4 continues to be our base case. Now, with added weight from the inflation trajectory. The overarching theme from the project remains the same. Risk management is the real edge. Stay diversified across sectors and geographies, particularly those that historically perform better in higher inflation environments. Hedge volatility when multiple signals align, and maintain patience during these below ADH grinds that make up 85 to 93% of market time. Today's price action at 654 is a good real-time example of why we emphasize patience at resistance zones. We're not forcing new positions while the market tests this area, especially with inflation forecasts shifting higher and adding uncertainty to the rate outlook. This kind of setup shows the value of having multiple systems working together, giving us both near-term price levels and a broader 2026 framework to navigate changing conditions. What do you think about the rising inflation forecasts and how they might affect the rest of the year? Are you watching the 654 to 671 resistance closely, or focusing more on the June, August timing window? Drop your thoughts in the comments. If this update helped connect the short-term action with the longer-term inflation and project outlook, hit like, subscribe, and turn on notifications so you don't miss the next one. Thanks for watching. Stay patient, stay prepared, and I'll see you in the next video.